Welcome everyone. This is our first independent sponsor webcast. My name is Sylvie Guedant. I'm a partner at Citron Cooperman and I lead the firm's transaction advisory practice. We are a full service accounting, tax, and advisory firm with 1,200 professionals across the US. As you know, our firm has issued an annual report on the independent sponsor sector since 2017. And this year, we decided to focus our annual survey on the impact of COVID-19 on independent sponsors, their portfolio companies, and the M&A environment. The survey was conducted in the last 2 weeks of May 2020, and it reflects the views of 112 independent sponsors. Just to give you a little bit of background on the group that responded, less than 15% had been an independent sponsor for less than 2 years. 23% had been in business between 3 and 5 years, and 63% were in business for over 5 years. So we issued, as you probably know, we issued the top 10 findings. And what we plan to do is to release a white paper in the coming weeks. So stay tuned for that. Today's webcast will be covering 5 topics: the impact of the pandemic on portfolio companies, investment strategies, due diligence, capital raising, financing, and the broader outlook on the sector. I'm going to have each of our panelists introduce themselves and their firm, and then we'll jump right in. So David, do you want to start?
Sure. Thank you, Sylvie. My name is David Achari. I'm a partner with AGI Partners. We are an independent sponsor based in New York City. Our focus is on the middle market. We do have an industry focus primarily around 4 industries: TMT, business marketing services, light and niche manufacturing, and healthcare. Since our inception, we have worked on 3 platform companies, executed 10 add-ons. Our team is 4 professionals, all based in New York City. And our capital comes from a network of family offices on a deal-by-deal basis, but we also have significant experience working with institutional managed asset management groups, including other private equity firms. Really looking forward to participating here. Sylvia, and thank you so much for thinking of me.
My name is Zoltan Berti, Managing Director at Oryx Private Equity Solutions. First of all, again, thanks, Sylvie, for hosting and coordinating this, and a great panel you've put together here. So Oryx Private Equity Solutions, we are one of the leading providers of equity capital focused on the independent sponsor transactions. So we are part of Oryx Corporation, a large global non-regulated financial services firm. But our strategy has been around since 2012. We've closed 35 investments with independent sponsors this end, deployed about a little over $650 million in capital, primarily equity. We do have the capability to provide kind of sub debt as well, but roughly 70-75% of our portfolio is equity, either control or non-control kind of equity. But the not so secret about our business is, that we don't want to be the sponsor. We want to back a good, credible, independent sponsor, and really we want them to be driving the car. And that's kind of how our model works. We don't want to drive the car. We're not asleep in the back seat, but we're there to kind of help as an active board member and help navigate. So obviously we're bullish on this sector, and it's been a fun ride, and so we hopefully and plan on it to continue longer.
Thanks, Zoltan. Max, do you want to say a few words?
Yeah, happy to. This is Max Dezzara. I'm the managing partner of Acquoia Capital, and it's a pleasure to be here this afternoon. I really appreciate the invitation. Just by way of background, we're an independent sponsor headquartered in Chicago. We have a sector focus and leader-led strategy. And there are really 3 sectors that we invest in, and each one of them is led by an industry icon. So our partners are individuals who have spent several decades of their careers in very accomplished operating roles within the industries in which we invest in. So as a result, we tend to be viewed a bit more as a strategic investor than a pure financial investor. We basically have 6 sector leaders across the board, supported by a 5-person transaction team that really are there to support our sector leaders. We focus squarely in the, I would define this sort of lower end of the middle market, and we define that as businesses between 3 and 15 million of EBITDA. While we cross various sectors, a common denominator is that each and every one of the businesses that we've invested in have been founder-built businesses. So we've always been the first institutional capital coming into the company. Our co-investment relationships are kind of bifurcated into 2 categories. About half of our deals we've worked with institutional investors, so PE funds, pension funds, SBICs, kind of equity-oriented SBICs, and the other half have been family offices, typically ultra-high net worth family offices. We've invested in 18 platform companies since 2011, along with 21 or 22 add-ons. And then we, along with our co-investors, have deployed well north of $300 million of equity capital across our portfolio since 2011.
All right, thanks, Max. And Doug?
Thanks, Sylvie. Good to be here with you all. I'm Doug Song from Protos Capital. We've been around since 2003. We are similar to the other independent sponsor panelists. We focus on lower middle market, which we define as companies with EBITDA of 2 to 15 million. We're generalists. We currently have 5 portfolio companies in diverse industries and under letter of intent for 2 new platforms. Glad to be here and look forward to the discussion.
All right, thank you, everyone. So let's get started. All right, we're going to talk about the impact of the pandemic on portfolio companies. And what we learned from a survey is a couple of things. So, first, 48% of the respondents said that the pandemic had a negative impact on most of their portfolio companies. 32% said that the performance was split, meaning some companies did actually better and others didn't do as well. So that's one thing. The second thing, which was actually positive, is that most portfolio companies received PPP funding. And I'm saying that that's a good thing because there was some question about the affiliation rules, meaning, when you aggregate all your companies, if you have more than 500 employees, you were not eligible for PPP money. But based on our survey, more than 80% of companies got PPP funding. And then the last one, which has been consistent in terms of conversations that I've had with many of our clients and independent sponsors and capital providers, is really the overwhelming majority of equity partners and lenders have been supportive, have been extremely supportive with portfolio companies. So, Max, let me start with you. How are you helping your portfolio companies adapt to this really unprecedented crisis? And are you performing a different role now? What type of priorities do you have working with your companies over the next few quarters, really until we have a workable vaccine?
Yeah, well, we have 10 active portfolio companies. So, part of the answer is it depends on the particular company and the end market that they're serving. Fortunately, most of our businesses were deemed essential businesses. All but one were deemed essential businesses. So it's, we've been able to, kind of continue forward. Our initial focus, Sylvie, was on, first and foremost, once COVID really hit us in the middle to latter part of March, it took everybody, frankly, by surprise. The initial focus was first and foremost on the health of our employees and making sure that we had, proper protocols in place to try to protect the health and well-being of our employees. Having said that, a very, very close second was ensuring that we had liquidity, that our liquidity was stable, and that we were going to have the financial resources to weather the storm. So very early on, we reached out very proactively to our co-investment partners and lenders to ensure that our businesses were going to achieve financial stability. And then, shortly thereafter, once the immediacy of the crisis seemed to, the initial shock and awe was over, we had a bi-weekly best practices across the portfolio, where essentially we brought all of the CEOs together to share best practices, because there's sort of commonality. While they're in different industries and different sectors and different sizes, there's commonality around the portfolio. And I've got to say, that was something that was extraordinarily well received, that the CEOs and leadership teams of our portfolio companies didn't feel like they were in this alone. They had other colleagues and peers that they could kind of share experiences with, and share best practices and share concerns across the board. And then in a few instances, we brought in subject matter experts to really speak to the companies around relevant issues. So, we brought an expert in very early on to talk about the PPP program, and proud to say that, every one of our companies that applied for the PPP were granted the PPP. But we brought an expert in to really help our companies navigate through the maze, the PPP maze.
Mm-hmm.
We had a session where we brought an expert in to really speak about cybersecurity issues. Cybersecurity during the pandemic, there were 3 times or 4 times the amount of cybersecurity attacks, basically attacking businesses here in the U.S. from overseas. And so making sure that we had a proper protocol in place to deal with any potential cybersecurity issues. And then the other area that we started to focus on a little bit later in the process, as the world was changing and we were adapting to a new reality, was the whole notion of Zoom conference calls, right? Which was something quite new to most of our portfolio companies. And so we brought an expert in to really work with our portcos to deal with best practices from a Zoom conference perspective, right? So I'm sure we've all been on Zoom calls where, you've got dogs in the background barking, and you're basically the camera, you're looking up somebody's nose, and it's just, so really working with our portfolio companies to basically guide them and train them on how to really have an effective and an effective Zoom, hold an effective Zoom conference call. So we did a lot of things to try to create a connection between the CEOs and deliver some meaningful value. And I'm proud to say that all of the businesses are completely stabilized. I honestly believe the worst is behind us. We're beginning to see some noticeable improvement across the portfolio. 2 of our businesses were able to pivot and take advantage of the opportunities that this market has presented us, particularly as it relates to the PPE segment of the market. So those are some of the kind of key areas we focused on. And then last but certainly not least, a significant amount of work with our lenders. To your point, as you've identified in the slide here, the lenders have been, by and large, extremely supportive. But we've gotten out in front of it and, have been very proactive about resetting covenants, because in many instances, if we didn't, we were going to trip them, and we wanted to really be proactive and get out in front of it. So those are some of the areas and some of the areas that we have focused on.
Yeah, that's fantastic. I mean, there was, the world changed completely in the middle of March. And just like you said, everybody jumped into crisis management. I love the idea that best practice, those best practice meetings across your portfolio and sharing ideas. And David, David or Doug, do you want to add anything to what Max said?
Yeah, I can add. We didn't do anything much differently than what Max has done. I think we've done all the right things. We work very closely with our portcos on a much more frequent basis. So before COVID-19, we did the monthly calls. After COVID-19, that turned into a Monday morning call. Before we used to just review on a high level basis, the P&L. Now we review the P&L in much more in-depth basis. We do a much more harder look on the pipeline report. We look at working capital very closely. And I think the other thing that we've done very differently is, we didn't sit back and just wait till things happened before we went to both our investors as well as our lenders. We were very proactive. So we spent a lot of time rationalizing the organization. We cut out discretionary spending, CapEx budgets were delayed. We focused on making sure that we can collect our money, pay our bills on time. But we also had a very proactive conversation with the banks way back in March. Yes, even though it was only 4 months ago, it feels like it's been some time. We did tell them some of the changes that we made and what we were going to do over the next 12 months or so. And the banks really appreciated that. And I think they were a lot more open to working with us. I've always had a personal philosophy of being transparent and trying to identify the problem as early as possible and try to solve it. And, March wasn't an easy time for us. And especially when you have to call investors and tell them, hey, remember that year-end letter I just sent to you? Well, things have changed. And I have to, let's talk about that. So, we did a lot of things similar to, what Max has done. And I'm sure a lot of private equity firms have done. I think as long as, you got very proactive, you're not going to solve the problem. None of this, what happened over the last 3 months is not the fault of anyone, but we do have to deal with it. And I think by getting those resources together, as well as not just identifying the short-term issues, but also make sure the long-term issues work well, because you never know what happens when you come out of this. So our conversations with our CEOs are, okay, we know the next 12 months are going to be very different, but when we come out of this, do we address our long-term issues? And, like, for example, we have a portfolio company that in the face-to-face market. And as you can imagine, in this market, it's very challenging. But we made a number of investments on the digital side. So we were able to repivot, the model to not, we were able to pivot the model where we can now offer a digital virtual component, which was well received by our client base. So, in March, while I had to talk the portfolio company executives off the ledge, over the last few weeks or so, I've seen their confidence grow quite a bit, and the attitude changes quite a bit. So, we'll definitely get through this. But I think if we were very proactive in addressing both the short-term issues and the long-term issues, we'll get through this, not just individually, but as an industry.
Thanks, David. And it's also maybe, let me go to you, because I want to talk about, the equity partners and lenders. So really, from our survey, it was, again, the vast majority were extremely supportive of portfolio companies during these unprecedented times. So, but that was Q1. So, do you see that changing in Q2?
I think if you look at it from the equity side, and I'll touch both the equity perspective, and I'll maybe give my thoughts kind of on the lender perspective. For the equity perspective, look, this was a major shock to the system, and so we're all long-term investors, and so we have to be objective in terms of how we review our investments. And so we do think that equity investors are going to have a longer-term view. Obviously, there is some uncertainty as to how is it short-term, mid-term, long-term. What is the impact here? And so I think we've obviously taken the view and worked with our independent sponsors and incorporated basically everything that Max and David have kind of mentioned in terms of how they've reacted. We've obviously been kind of taken the same position and been very involved with our independent sponsors, very involved with our portfolio companies, and frankly, we have the added benefit of having 30 plus active portfolio companies. And so we've done that very similar kind of best practices approach that Max kind of mentioned about. But yeah, look, so I think we take a very objective, and I think most equity investors will, right? They'll take an objective view and assessment. Is the original investment thesis still valid, or can it be modified or pivoted to maintain kind of a commensurate kind of value creation strategy with a pivot? And that's what really drives our decisions. And so it's been short-term so far. We've been supportive of our companies. We've made additional equity investments in our companies where we felt it was necessary. But, I think as Max and David mentioned, right, I mean, we were working with our partners to pull every lever possible to try and get some accommodations, and whether that's from, senior lenders to landlords to obviously the public stimulus, and, and obviously we all had to make some tough decisions too when it came to personnel, whether there were going to be, short-term reductions in force or furloughs or compensation cuts, et cetera. But those are all, we take an objective view, and I think the equity community is not, very similar across that. Might be a little bit of differences if your partner is an institutional partner like us versus maybe high net worth investors. There might be just a timing and a little bit of a short-term challenge in terms of, a little bit of herding cats and obviously maybe a little different perspective, but ultimately I think the same viewpoint, will and can be reached. From the lenders' perspective, absolutely. We've seen a lot of support across our portfolio and across the markets. I do think, though, maybe just to put a little bit of devil's advocate, I mean, it will be interesting to see what happens with the June kind of covenant reporting period, right? Once those covenants, the June financial reports get submitted and covenants are tested, for folks that maybe haven't been as proactive as maybe, Max mentioned in terms of trying to get ahead of it with terms of resetting or reassessing kind of covenants. It will be interesting to see, is there a different perspective once we get through that June reporting period, if senior lenders or banks find that they have probably more concern about their portfolio than they did, 2-3 months ago. That's probably a little bit of the wild card that may, create some choppiness, and I think the lender support. But again, I think the transparency and communication that everybody's echoed or spoken about is absolutely going to be key to continue kind of the positive, I think, relationships among all the constituents in the capital stack.
All right, thanks, Alton. And let's go on to the next topic. So investment strategies. So we wanted to inquire about, the impact, and it's, again, this was done at the end of May 2020. So in the middle of it, but what was the potential impact on investment strategies and deal structures? And what we learned from those surveys that, for many, really, their investment strategies would remain the same. As you can tell when you look at the chart, changing investment focus, 20%, changing industry or sector focus, only 17%. So basically, everybody said we are staying the course. What we did before still works now, and we're going to do, we're going to remain the same. Some said, though, that they would be more likely to consider add-on acquisitions, that's 40%, and then 36% said that they would consider distressed opportunities. And just to add to that, those that responded yes actually said that they had significant experience or some level of experience with distressed investments, and they just saw this as an opportunity given the current environment. The one thing that's really changing is deal structures, or expected to change is deal structures. And we have a little more on the the right hand side of the slide is what's expected to change is lower leverage close, less cash at close, and then increased use of earnouts and seller financing. So, David, what do you think? Do you agree with these findings? What's your take on it?
Yeah, so none of these findings surprised me. Everything that I saw on the statistics I've saw in your survey, what I've seen on this slide, I agree with. I'd be interested if we took the survey today, would the numbers just be even higher? But I agree with the general findings. Deal structures. A lot of things will change. I think, one, there's going to be more or higher percentage of the EB in an earnout component. I think there may be even a higher percentage of rollover. I think there's going to be some more appropriate risk sharing, between buyer and seller from an economic perspective. I think the big question is not the multiple and whether it's going to expand or contract, but what are we applying the multiple to? Okay. You can't use 2019 EBITDA because it doesn't understand or reflect anything that's COVID-19. You can't use a traditional TTM because, you could potentially leave a lot of value on the table. And it's hard to buy a company based on forward EBITDA, no matter how well a seller positions their pipeline reports and their projections. So, I'll make a prediction, very similar to what happened in 08, 09. We may look at, some kind of average of some of these numbers. I think also people are starting to get creative with ad backs. I think, if all of us, we all have LinkedIn accounts, and I'm sure one of our connections posted the famous coffee cup that says EBITDA plus C, which is COVID-19 ad backs. So we'll have to see how that turns out. But I also think, there's going to be appropriate risk sharing just from an economic perspective. Also, I think there's going to be some appropriate risk sharing from a legal perspective. Prior to COVID-19, sellers had tremendous leverage as to what they can ask for and what they can't ask for. And I think now there's going to be some appropriate risk sharing and some more symmetry in risk that's reflected in purchase agreements. So, the findings, none of that, surprised me. And I think, just going forward, there's going to be some a much more aligned distribution of risk between buyer and seller, both from an economic standpoint as well as from a legal standpoint. Yeah.
Okay. Thanks. Question for the group. What sectors do you think hold the most potential due to the pandemic? Who wants to take that question?
I can start. Sylvie. I think, what we're focused on obviously is staying away from any cyclical industries. I think that's, I'm sure everybody else is doing the same. But, some of the sectors that we like during this COVID crisis and the post-COVID crisis are sectors such as infrastructure. We believe that the government will have very little choice but to pass a infrastructure stimulus bill, a rather large one, and we think the infrastructure sector will benefit from it, not only because we need that type of upgrades to the infrastructure of this country. So that's a sector we like and we're trying to pursue. Anything to do with remote working or living or education, those are sectors that we like at the moment. I'm sure that's obvious to you all. So those are the two sectors that we're trying to focus on at this time. That's not only going to be good during the time of COVID, but also post-COVID.
Okay, thanks so much. Maybe we can move on to the next topic, which is due diligence. And here you go. So we asked a question for any type of for buy-side deals in process. Was there still a plan to close? And 63% said yes, 34% said not sure, and 3% said no. And just to add to that again, based on another question in the survey, the ones that said yes, they said, they expected to close by the end of 2020. So maybe not right now, probably would, wait it out and see how the businesses, went through the next couple of weeks and months, but they still plan to close, by the end of 2020. So the question is, how do you perform due diligence now during a pandemic? We had those questions, and you have the findings on screen. But also the question is will due diligence change post-COVID? So I figured we would talk about both. And Doug, let me go back to you again. And so, what do you think? How did due diligence change in the past couple months? Are you asking different questions of companies and management teams now? What do you think?
Well, I think you're absolutely correct, and the survey is correct also. I think deals are just taking longer because of this crisis. And because also both lenders and equity investors are also more cautious in this environment. So I think naturally everything's going to take longer. But some of the things that we're trying to focus on is we're trying to determine, for example, if companies are going to lose revenue, is it lost and it's gone, or is it just delayed or deferred? So that's a key question for us when we're looking at businesses. We're also looking at businesses that may potentially benefit from COVID, as I pointed out earlier, in the type of industries we're going after. That may also do well post-COVID. So those are the type of businesses we're trying to focus on at the moment. I would say also from a supply chain standpoint and operational standpoint, we're trying to be very, very cautious about any companies that have a good deal of exposure to outsourced manufacturing, for example, in countries that might be deeply impacted by COVID. For example, we have an agriculture company that was sourcing agricultural products from India. And when India went into a lockdown, obviously that completely disrupted that supply chain. And then furthermore, the ships and ports were also shut down. So, we're very sensitive to those type of disruptions. And on the demand side also, if we have demand that is in other countries, and if transportation or demand is not there, that's really also going to be key due diligence points. I would say from a financial due diligence standpoint, we are looking at, obviously we need to look at what 2019 results were, but we're also looking at, how has the business performed during the COVID crisis? And we believe that the trough was in the sort of March to April timeframe. So the important thing for us to see, and we're making sure this is part of our due diligence, is how is the business performing, and is it recovering from that trough? And if it isn't, we need to determine why, obviously. And lastly, one of the things we're doing is we're looking at the 2020 performance, which I just spoke about, versus the budget. And I think every company has by now gone through a new budget for 2020. And then we're also comparing these businesses and how they're comparing during this crisis to the Great Recession. I know that it is not a completely accurate prediction, but it does show us how the business performed and how the management performed during the last the last recession. So those are some of the due diligence points that we're looking at. And finally, one of your points here is, will you close a deal without meeting the owners? And the answer is absolutely no. So we're deploying private planes if it's reachable by private plane and or car, and we're really not doing anything where we can't meet the management and the owners. So that is limiting our scope a bit, but we believe that is an important part of our decision-making process in terms of partnership and the type of companies we want to partner with.
Yeah, it's a really good point. I've heard of some private equity groups that are maybe closing add-ons without meeting in person, but definitely not a platform investment. But Max and David, if you want to start, are
Sure.
you doing it differently now?
I'd agree with Doug. I mean, we've done very similar things to what Doug has said. I think the one thing I'll add to it is that with respect to due diligence, we're spending a lot more time understanding the granularity of the organization. It's just no longer looking at charts and boxes and arrows, but asking much more deeper questions. If we have to have employees work from home for an extended period of time, can we do that? One of the things of one of our platform companies, one of the purchases that we had to do in March is to buy a selected group of employees laptops because they were using laptops at home, but they were in a particular point in life where they didn't necessarily have this type of computing power at home, and they were typically more blue collar type jobs. So, we're doing in terms of of looking at deals right now, we're probably doing something very similar to what Doug's been doing, but we've done. I would say that we've looked at the human capital aspect in much more detail, and asking some of the questions that we haven't asked in the past, like as if these employees would have to work from home for an extended period of time. The other questions, how are we handling management meetings? We would close a deal without meeting the owners in person? Absolutely no. Because if something goes wrong, the first question investors will ask is, what was your due diligence process? And if the answer is that you closed on a $30 million deal based on a Zoom call, that's something that you don't want to say, and you don't want to look forward to the aftermath of that. At AGI, we're very close in buying an add-on through a 363 bankruptcy process. And the reason why we were comfortable in doing that, Sylvie, is we actually know the owners. We've spoken to him, many times over the last 2 years. It was a case where he had a good business, but he wasn't a good CEO. And, we were able to, generate some value from that. But, if we have not met the CEO and we have not had an extensive knowledge of his operations, I don't think we are going to go through that. AGI is also looking at a platform company in the technology sector. We know the CEO very well. We have met the CEO many, many times, even before COVID-19 hit. So we were able to, move the diligence process online and still get comfortable. And the business is, less than 100 miles from New York City. So we can able to drive to the platform company if need be. So in that case, we were much more comfortable in moving forward. But when a banker calls me now and says they have a new deal to introduce to me, I think about how are we going to meet this company? If it's halfway across the country, I'll be comfortable in getting on a plane and doing that. I'll be comfortable in getting a capital partner to get on a plane and come and meet with us. I mean, those are much more longer term questions. I do believe that the 120-day exclusivity period is going to come back, and it's going to take longer to get deals done in that case.
Yeah, for sure, and that's what we're experiencing too. We have several deals in process, and it's just taking longer. So let's talk about in Zoltan. Let's talk about post-pandemic. Do you think that we're going to keep some of those practices, from the COVID era? What do you think the lasting impacts would be to due diligence going forward?
No, sure. I think this is going to be a great learning experience for all of us. I mean, the one thing that I hope we don't have to include going forward, I know we all have recession cases in our financial models. I hope we don't need to include a zero revenue pandemic case, because that would be unfortunate. But look, I think some of the things that we have learned from this that I think are going to be maintained as part of diligence is, at least from our perspective, obviously we're going to have a more kind of robust focus on liquidity, really stress testing kind of operating liquidity, perhaps including a 13-week cash flow as part of a kind of a reporting process, going forward. I mean, and obviously making some stress tests on slowed cash collections or potentially stretching payables, considering kind of those type of situations. I think one of the other areas I think that'll additional diligence that I think Doug mentioned, it's really around supply chain. It's instead of just looking at your vendors and seeing that there's not a lot of concentration, it really is going to be doing that deeper dive, understanding what alternatives are available, how easily can those alternatives be turned on, what is their geographic location, what is the political climate where they are. And so I think it's doing a little more deeper dive. And frankly, to that point, and a combination of two is inventory levels and forecasting in terms of, do we need to hold more inventory potentially, and how do we kind of realize that? I think some of the other outcomes are pretty evident, right? I think there's going to be more of a focus on making sure companies do have policies and procedures around employee safety, facility hygiene that maybe were just taken for granted before. Same thing with systems, right? The ability to make sure the systems had the capability and frankly, having the ability to provide secure remote access, for a portion of the workforce. And so I think those are, going to be incorporated as part of kind of more of a, whether it's a systems review or just a policies and procedures kind of review. And maybe last but not least, and this is always the squishiest part, right? I think, it's going to be really trying to do a deeper dive on management, in terms of at least in the C-suite. Do we have true leaders in place that, can react in a crisis? Because it's so critical, as we've seen, that, a company's response and the tone, really comes from the top, and managing that messaging, managing employee morale. And again, this is a squishy piece. How do we, obviously we've all been investors for a long time, and we're going to look in the whites of their eyes and really try and understand kind of their track record. Maybe it's, doing some behavioral assessments or some other type of kind of more statistical type of analysis. But I think those are some good lessons learned, and I think that, will and can be incorporated into diligence processes going forward.
Okay, thank you. For the attendees, if you have any questions, you can enter your questions under the Q&A. We'll address all questions at the end. We're leaving a few minutes for Q&A. So let's move on to the next topic, which is capital raising and financing. So the results were really clear, and that's what we are experiencing too, is that you have to go broader with your capital sources. So you have to expand your capital sources, and then it also, expect to take longer. I mean, we talked about due diligence, but also securing, financing and fundraising will take more time. So, Max, do you agree with these overall findings? What's your take on it?
Yeah, absolutely. I think this is really, spot on, frankly, and very consistent with our experience. So one of the things we did early on, and I say early on, I'd say, we let the dust settle for about 30 days. So, middle of April, we reached out to a number of the co-investors that we've cultivated relationships with over the last, 10 years or so. And we frankly reached out to about 36 of them that we have the deepest and most meaningful relationships with, just to try to get a sense of their temperature and how they were viewing the market and viewing opportunities. And it was interesting. I would say that 2/3 of them were largely on the sidelines. In other words, not really looking to deploy capital in this market, given all of the uncertainty, uncertainty around the severity of the recession that we find ourselves in. Is it a severe recession? Is it bordering on a Great Depression? I mean, there's a lot of uncertainty around the macroeconomic issues that we're all confronted with. And then really, some concerns about the specificity around how any one particular company will respond and perform in the midst of the pandemic. So 2/3 of them were, I would say, squarely on the sideline. I think the other contributing factor is that many of the co-investment partners that we reached out to had their hands full relative to their existing portfolio companies. So getting back to the earlier conversation around, making sure they had the PPP, making sure they had the 13-week plans in place and contingency plans in place, and just dealing with the real-time issues related to their existing portfolio companies. They were not really anxious to deploy capital in this uncertain climate that we find ourselves in. So 2/3, I would say, are squarely on the sideline, likely will not be putting out capital anytime soon. And I mean sort of the next 6 to 9 months until there's a little bit more clarity on the markets. Out of the remaining third, I would say that 80% of the remaining third were claimed that they are open for business. Mm-hmm. But having said that, the bar is definitely higher. So, where property, so valuation metrics and sort of being able to buy right is an appealing attribute. So, where a business pre-COVID may have traded at 7 or 8 times, if that same business was going to trade at a turn or two lower, that would certainly motivate them to take a serious look and seriously contemplate deploying capital. So bar is much higher for the, those remaining co-investors that actually have a desire to deploy capital in this market. And handful of them, it was interesting, handful of them are, really historians, and it was quite interesting to have these conversations. A handful sort of shared that the best returns that they've achieved came out of the Great Recession. So deals that they did in 09, 10, and 11 really outperformed. Those were great vintages. So as a result, the remaining group really see this as a unique and maybe an extraordinary opportunity to deploy capital. So taking a bit of a contrarian perspective. And then there were 10%, so roughly 3 or 4 of the firms that we spoke to that are really focused on, I'll sort of describe it as a rescue financing, right? So businesses that pre-COVID were healthy businesses, most likely consumer-facing businesses. So think about national fitness centers, national yoga studios, hair salons, consumer-facing businesses that pre-COVID were fundamentally healthy businesses that may have been, sort of call 10 million of EBITDA north, that may have been trading at 7 or 8 times, that are now doing zero revenue, literally zero revenue, right? Deemed non-essential. But the view is that those businesses ultimately will come back, right? So once there's a vaccine, whether it's 2 years or 3 years, things will get back to normal. People will go back to gyms. People will go to get massages. People will go to get, the hospitality sector, be it restaurants and others. People will ultimately find their way back there. And the view is, look, if we can pick up a business that pre-COVID was trading at 7 or 8 times, and we can pick it up at 3 or 4 times, and just ride it out, right? Provide the necessary capital to weather the storm and ride it out. And look, these are businesses that they believe will really rebound pretty quickly on the other side of this, and you can generate a really handsome return. So I found that quite interesting. The other key learning is, definitely, at least from our experience, the first 2 points are spot on. We absolutely need to broaden out our capital sources. One of the things that, as I mentioned earlier, half of our co-investors are institutional investors, the other half are family offices. And, the adage, if you've met one family office, you've met one family office, is quite true. They don't have the same pressure, frankly, to have to deploy capital. And our experience is many of the family offices are really on the sidelines. So, we're finding that some of the institutional capital providers are a bit more reliable, and we have really spent time expanding our reach within and broadening out our reach within the capital sources. So, I concur 100% with the first point. And the second point, I think, our view is it will absolutely take longer to secure fundraising. It's going to require, as we've just discussed in a previous slide, much more extensive due diligence, a prolonged due diligence process. Given that we're not able to just, quickly jump on a plane and meet folks, we've got to sort of stage the process and elongate the process through more conference calls and Zoom conference calls before making a commitment to actually get on a plane and go visit with a potential target. So as a result, there's no doubt that it's going to take longer to secure fundraising. And from an independent sponsor's perspective, frankly, add more complexity and add more risk into the transaction. And then the final kind of component is the lending sources, right? So as part of our process, we reached out to about 3 dozen equity co-investors, and then we also spoke to close to 2 dozen lenders. And kind of similar dynamic, many of the lenders are focused inwardly on their existing portfolio, making sure that the companies that they've already provided financing to are sufficiently well capitalized and have liquidity to weather the storm. So as a result, many of the lenders, traditional lenders, I'm talking about the senior lenders, are really on the sidelines. our sense is leverage has come down across the board by a turn or two. Total leverage has come down, by a turn or two. So you've got the senior lenders on the sidelines, the BDCs for all practical purposes are on the sidelines, which is creating an opportunity for the mezz firms to step up and fill that void. They seem to be pretty active. And then of course you have the one-stops, right? The unitranches that are continuing to be in the game. But again, the bar is significantly higher. And getting back to some of the earlier points that were made around sustainability of EBITDA, what EBITDA are we really underwriting? It's just a lot more complexity from a financing perspective, which is going to elongate the time, going to add complexity and a risk to actually, getting a deal over the finish line, and clearly have an impact on valuation, right? Because we're coming out of a historically high valuation environment where things were trading at very frothy multiples, and that was a pre-recessionary environment. We find ourselves squarely in a recessionary environment. So all of those factors together are going to certainly have an impact on valuation as well. So I agree entirely. Yeah, I agree wholeheartedly with this with the slide.
Yeah, thank you. That was very comprehensive. Zoltan, I don't know if you want to add anything to what Max has said. Since you're the sole capital provider, in the group.
Sure. Look, I mean, that was, I again agree with everything kind of Max has said. I mean, the one thing that I think we all, is ultimately a net positive. There's just a lot of dry powder of capital out there. So, ultimately, I think where, if you find a good investment opportunity, it may be harder, it may take more time. Again, there's just some uncertainty, but the capital is out there and rational investment decisions will be made. And I think that, that obviously is a net positive that I think underweighs, the entire kind of asset class.
Mm-hmm. Could we talk a little bit about deal economics? I mean, and I guess question for the group. Do you think that deal economics would be impacted in any way because of the crisis? I don't know who wants to take it on, maybe David?
Yeah, on this, it's very hard to, because there's no empirical evidence, there's no historic, perspective on this. Mm-hmm. But I do think that the one constant is with respect to independent sponsor economics in light of COVID-19 really depends on the pricing of the deal. It really depends on whether you have your value creation plan put in place, and as well as just the actual multiples coming in. So if you take a deal that's, and I'll just throw it out there, that's 8 times to a capital partner and they like it, I think the economics of trying to get something that's more, quote unquote, more market, I think will be a lot higher. Versus, if you have, if you're in the fortunate position of finding a deal with a mid-single digit multiple, then I think, your ability to negotiate a good, compensation package as an independent sponsor has certainly gone up. Do I think, one of the 3 economic approaches in an independent sponsor deal is going to be dropped? No, I think it's the same issues that we faced. I certainly would expect a transaction fee, some kind of sharing of the monitoring fee, and the carrying and the carried interest. So again, this is probably the only constant in a world that's consistently changing, which is the approach to independent sponsor economics really depends upon the transaction itself. So, if it's a very high purchase price, I think it's very hard to get, market economics. And if you have a reasonable purchase price, I think, I think the capital providers will be open to, being much more generous with the economic package.
Mm-hmm. Yeah, go ahead, Sultan. Sorry.
Yeah, I was just going to add, I agree with, absolutely agree with David comments on, there's some underlying factors that are critical: the valuation creation strategy, Although I would say our general view has always been, and frankly, I don't see it changing, is that we really view economics should reflect just a incredibly strong alignment with our partner. And that, both on the upside, so the carry promote aspect of it, as well as on the downside. And that's where we view, obviously, whether it's fees be enrolled or cash equity investments, our view is it's a partnership. And that partnership has to make sure that the alignment is optimal. And we don't see that changing. Again, there are some nuances and tweaks to it based on the valuation creation strategy. And frankly, I think, there always have been and maybe will continue to be, kind of adjustments to the carry and the promote structure that could be reflective of outsized returns and some corresponding kind of carry on that. So again, our view is we don't see a fundamental change, kind of that will impact kind of at least how we view kind of this partnership and alignment model.
Okay, great. Maybe we have about 15 minutes left, so there are no questions, but I think we could go to the next topic. So let's switch over to the outlook, which I'm sure we'll have a lot to talk about. So it caught some by surprise, and myself included, but so we wanted to know if the COVID-19 crisis would have an impact on the number of independent sponsors. And just to give you, some data points, we have a proprietary list of 2,000 independent sponsors, and a lot of them have been in business for a long time, but the number has increased significantly in the past 5 years. So question is, will this crisis have an impact on the number of independent sponsors? And 54% thought that the crisis would reduce the number of independent sponsors. 19% said it would grow it, and 17% thought that the number would stay the same, and then 10% thought it was, they weren't sure. So I figured that we could take both sides, and maybe Zoltan, if you want to speak about why some thoughts, 54% thought that this crisis would actually shrink the independent sponsor community. What are your thoughts?
Stepping back, the Oryx Private Equity Solutions business model is tied to the independent sponsor asset class. So I'm inherently optimistic about the long-term success of this asset class. And again, I don't, and it really has become an asset class versus kind of a cottage industry.
Right.
That being said, look, there could be some pressures, going forward that, maybe have been heightened by this crisis. Obviously that negative perception about certainty of execution, about, not having dedicated capital, that's not a new kind of a, excuse. But, I think with the uncertainty out there, I could see advisors, sellers and their advisors, being really focused on trying to kind of minimize or eliminate all contingencies, and, access to capital, being able to kind of write a check versus raising money, is something that negative perspective or perception, might be heightened. I think, we look at a lot of our independent sponsor partners out there. A lot of their business is highly reliant on proprietary deal flow, where they've invested, a fair amount of time to develop those relationships and cultivate relationships directly with business owners. And, it takes time to develop those relationships. And obviously this little blip has maybe, is going to make that harder over the longer term, possibly, to kind of develop those deep relationships. And, look, and for independent sponsors that are newer and maybe don't have a portfolio and maybe don't have, a management fee coming in, if they might not have the ability to withstand, kind of a longer deal sourcing, process or time frame. Sellers possibly, as they've lived through this, as they lived through the Great Recession, their immediate reaction from this is, look, they just want to exit. And so they're going to be more focused on, an outright, buyout, versus more of a structured recap with second bite of the apple. And that might make it a little more interesting, They might be more inclined to go with the traditional big, PE fund or strategic, kind of buyout there. And, maybe last but not least, I think as we just kind of discussed, one of the earlier slides, I mean, it may be harder to kind of raise this capital from other lenders, and as there's maybe some concern or just more, a little more cautious approach. So again, I don't think any of those are new to the independent sponsor community. They might be a little bit more heightened in terms of as we come out of this, so it may create, some pressure. Obviously, I hope not, but I think those are just a couple things that I've kind of thought about.
Mm-hmm. Mm-hmm. Thank you. Doug, do you want to take the other side of it and argue why, you think now it's going to grow the independent sponsor community?
Sure. I would say I could argue both sides, as Zoltan said. I could argue both sides as well, but I would say that, somebody mentioned dry powder before. I think I read just the other day that there's $1.5 trillion of dry powder at PE funds currently. Now, as you all know, these funds have a life, so they need to put this money out. And independent sponsors is still an important deal source for this community. So that's one stat. I just don't see this community going away. I think it's here to stay. As Zoltan said, it's become a real asset class. I think it is here to stay. I mean, just look at between David, Max, and our firm, we have something like 20 portfolio companies between us. So when you have sponsors with those type of portfolios and track records, I think there is some sustainability there. And I think the real pressure is going to be if you are not able to source and do deals in this environment for whatever reason related to the COVID or et cetera, or deals take longer. I think obviously that puts some pressure on the independent sponsor community. But I happen to believe that it's going to be hardest on the newer independent sponsors that might not have 2 or 3 portfolio companies, because if they don't have those management fees coming in, those revenue streams coming in, and they're not able to do deals because just everything is more difficult in this environment, I think that's where the stress will be. But again, I think there's going to be people that come in and out of this market, but I just don't see this going away. So I can't tell you if it's going to grow immediately, but I expect that this community will continue to grow over time. That would be my sense.
Okay, thank you.
Yeah, Sylvie, on this, out of all the questions and answers on your survey, this one really surprised me in terms of contracting, the industry contracting as a result of this. Mm-hmm. As Doug outlined and as Zoltan outlined, both have made great pros and cons. I was very pro. I thought this industry is going to grow, with money on the sidelines. The amount of marketing that private equity firms have spent on marketing to independent sponsors has grown quite a bit. And quite frankly, it hasn't even stopped over the last 3 to 4 months. I am getting calls from, traditional private equity funds with a fund life about looking at deals. So, but I think what could potentially contract this industry is, I think some of the newer independent sponsors who don't necessarily have the track record or what I like to call the multi-cycle investing experience, they're going to be challenged, and they're going to see this. They're going to realize that they won't be able to close a deal within a certain period of time, and then as such they'll have to go without any money coming in, and they have families. So when you have to think about those types of perspectives, I think they're going to be very challenging for them. But I think the players who have been in this industry during multi-cycles, I think will not just continue to be around, but they will also grow.
Mm-hmm. Mm-hmm. Max, do you want to add anything? And also, given, has your outlook changed, especially in the past week? As you know, we're hitting new records in COVID cases in several states in the South and the West. some states are slowing down their reopening plans or reversing them. So any take on that and from the group really? And Max, I don't know if you want to start that.
Yeah. Well, I'm not so sure that the last week is going to have a significant impact on the overall conversation we're having. I tend to agree with Zoltan. I mean, I really think the independent sponsor community has come into its own and frankly is its own independent asset class. And for the reasons he mentioned, look, we're adding a lot of value to institutional investors. The majority of the deal flow that we generate is proprietary deal flow. They're businesses that we, generally have a unique angle on, and they're businesses that we're generally able to buy right. And as a result, we can, justify our economics and justify sharing some of the upside. So I think for all those reasons, I think in the long run, it's going to be a very stable and growing asset class. Having said that, I do think, until there's some visibility on the COVID situation, either a vaccine or there's just greater comfort around all the ambiguities around COVID, I think we're going to see a contraction. And I think that, as others have stated, the younger independent sponsors that are just starting off in their careers may not have the staying power. And as we discussed earlier, it's going to take longer. It's going to be more complex. It's going to, these transactions are going to have a bit more risk until there's better visibility in the market. So I think short term, my view is we will see the industry contract. I think long term, it's going to be very stable and ultimately a growing asset class.
Okay, great. Thanks for that. So we have no questions in the Q&A. So I guess we answered all of your questions, but I do have a final questions for our panelists. And this is a question, is what will be the greatest impact of the crisis on the independent sponsor sector? Who wants to start?
I could start. Sorry, Max. I could start, Sylvie. This is to me a very difficult question. I think there'll be multiple impacts, but I guess if you have an existing portfolio, it has to be sort of how did the portfolio or the companies in your portfolio perform during the crisis? I think that's going to be a key sort of determinant for the independent sponsor community. And secondarily, I think we all need to think about how to perform our financial performance with and without COVID. Because when you look, 2-3 years from now, when you're looking to exit a company or when you're building your track record, my sense is we're going to have to perform an asterisk this time period. So those would be my 2 points.
Okay, Max, do you want to go next?
Yeah, happy to. Okay. My sense is that there's going to be a renewed emphasis on really having a unique angle on the deal, and whether that's having direct operating experience where you can really create a differentiation and really develop a connection with the business owner and justify the value proposition to the capital providers and or sector expertise. I think it's going to be, I think the generalist investor is going to be really challenged in, without a unique kind of value proposition or a really unique angle on the opportunity. It's going to be really challenged in this environment. Mm-hmm. So I would say, a renewed emphasis on having an angle either through direct relevant operating experience or deep sector expertise.
Okay, Zoltan, do you want to go next?
Yeah, I actually, that was going to be kind of, I think, my kind of similar comment that I think, because we're going to be, I think, as investors, trying to kind of predict maybe some long-term changes that have come out of this, both consumer behavior, both in supply chain impact. I think it's going to be a path to success is going to be more focused around some of that sector expertise or specialization or that uniqueness of the angle that the independent sponsor will bring to it. So, unfortunately, it is repetitive, but I think it's going to be tougher for a generalist to be able to have that level of differentiation out there, because I think that's going to be one of the key areas that will continue to create, I think allow for the success here. And so I think that, it's just tougher. It's just gotten tougher and tougher for the generalists. And I think it's, this is going to make it even further challenging.
All right, thank you.
Yeah, unfortunately, Zoltan stole my thunder, but it's times like this where I think the journalist model is very challenging. We learned during the 2008 to 2010 period that we're not experts in everything, and suddenly we dropped out of a lot of industries that we initially looked at deals, but I'm glad that we didn't move forward, including energy and retail services. And we ended up, focusing on the investments and sectors that we had track records, that we had a lot of professional resources, not just, in terms of service providers, but also in terms of our operating executives network. And, with that in mind, we AGI refocused, its investment industries on those cycles, on those industries. And as such, we were able to, I think, differentiate ourselves, not just among, potential portfolio companies, but also with capital providers. Because I think right now, unless you have a very large team, and I'm talking about 10 plus professionals, I think it's very hard for the generalist model to survive, and not just the independent sponsor community. I think just just among the private investing community.
All right. Well, thanks so much. And our time is up. So I want to thank our panelists, David, Doug, Max, and Zoltan, for their time today. Really appreciate the insights. And I want to thank also all of you for joining us. And I want to invite you to our next webcast, which is going to be on July 14th at 1 p.m. Eastern Time. We are going to talk about, like David said, EBITDA, so assessing the impact of COVID-19 on lower middle market valuation. So that is it. So stay safe, stay healthy, and have a wonderful holiday weekend.
Thank you.
Thank you.
Take care, everybody.